Listen, I want you to picture something real. It is a Saturday afternoon in suburban Cincinnati, late May 2026, and Frank is 74 years old, and he is standing in his garage holding a fishing rod he has not used since 2019. The garage smells like motor oil and old grass clippings. The Buick is on the left, the Chevy pickup is on the right, and between them is a workbench Frank built himself in 1987, with his father-in-law's help. His father-in-law has been dead for 19 years. His first wife, Margaret, has been dead for 3. And 6 months ago, on a Tuesday in the courthouse in Hamilton County, Frank married Diane. Diane is 58 years old. She is kind. She makes a chicken salad with grapes and walnuts that Frank cannot stop thinking about. She laughs at his jokes about the Carter administration. She rubs his shoulder when his back hurts from the garden. She is, by every measure that Frank can identify, a good woman. And Frank, who spent 41 years as a regional sales manager for an industrial supply company, who paid off the house in 2008, who has $612,000 in his old 401k rolled over to an IRA at the same brokerage where his guy in the navy blazer takes him to lunch twice a year, Frank has just done something that, mathematically, has put a knife to the throat of his 2 grown children. He does not know it yet. He is in the garage, looking at the fishing rod, thinking about asking Diane if she wants to drive up to Indian Lake next weekend. Through the kitchen window, he can hear her humming along to a Carole King record he bought Margaret in 1973. What Frank does not know is that on the day he said "I do" in that courthouse, federal law, specifically the Retirement Equity Act of 1984, automatically rewrote the beneficiary on his $600,000 401k. It does not matter what the form says. It does not matter that his daughter Allison's name is in ink on the paperwork from 2009. It does not matter that he and Margaret sat at the kitchen table in 2011 and went through every account and made sure the kids were named. The rules changed the moment he signed the marriage license. And nobody, not the brokerage, not the attorney who drew up his prenup, not the friendly young woman at the bank who congratulated him, told him, "I'm going to tell you, because I spent 30 years inside the system, and I am sick of watching this exact scene play out in 3,000 garages every weekend in this country. The mechanism that has been laid for the over 60 remarriage is one of the cleanest, quietest, most surgical transfers of generational wealth ever designed by the United States Code. It does not make the news. It does not get a press conference. It just empties one family's account and fills another's every single day. And the brokerage industry profits from the paperwork on both ends. Listen to me carefully. If you are over 60 and you are remarried, or you are about to be remarried, or your widowed father just started dating a woman named Diane, you need to hear the next 25 minutes word for word. There are 3 specific accounts that change ownership the moment a wedding license is signed. There are 3 specific moves you have to make before that signature, not after. And the window is narrower than you think. Stop the video right now. I want you to do one thing. Hit the like button. I do not care if you like me. I do not even care if you finish the video. I care that you push it forward one notch in the algorithm, because the algorithm in 2026 has a documented suppression problem on senior financial content, and the platforms do not want this video reaching the people who need it. There is research published by independent watchdogs this year showing that financial warnings aimed at adults over 60 are systematically deprioritized in favor of broader lifestyle and fitness content for the same age bracket. The system, even on this platform, does not want you informed. So hit the like button, then hit subscribe. The channel is called John Warns You, and the only thing I do here is tell people what I was forbidden to tell them when I worked inside the apparatus. Then hit the bell, all notifications, because when the IRS quietly updates a rule in February, or the courts issue an opinion in March, I want you to be among the first 3,000 people in America who hear about it, not the last 300,000. And the suits in the legal department want me to remind you, this is not financial advice. This is not legal advice. This is not tax advice. This is a survival guide for the American retiree who has just realized that the laws governing remarriage after 60 were written by people whose primary clients were not retirees. If you want personalized advice, go pay an elder law attorney $400 an hour. What I am giving you here, for free, is the warning that attorney is going to charge you $1,000 to hint over a conference table. Now, Frank, $600,000. Diane, the garage, Let me tell you what actually happened mathematically, word by word, so you understand the size of the crime. There are 3 accounts that quietly change hands the second you sign a remarriage license at 60 or above. I'm going to walk you through each one. I'm going to name the federal statute. I'm going to give you the dollar amount, and I'm going to show you what happens to your kids if you do nothing. The first account is the qualified retirement account. Your 401k, your 403b, your pension if you still have one, and in many cases, the rollover IRA that came out of those plans. This is governed by ERISA, the Employee Retirement Income Security Act of 1974, and it was amended by the Retirement Equity Act of 1984. Here's the dirty little secret that the brokerage industry has been hiding for 40 years. Under federal law, your spouse, meaning your current spouse, meaning the person you married on Tuesday at the courthouse, has an automatic statutory right to 100% of your qualified retirement plan, death benefit, not 50%, 100, unless your spouse signs a notarized waiver in writing on a form that is specifically compliant with the regulations. After the marriage, your prior beneficiary designation is legally void. Read that again. Your prior beneficiary designation is legally void. Frank named his daughter Allison in 2009. Frank signed paperwork. Frank had the carbon copy in a fireproof safe in his basement. None of that survives the wedding. The instant the Hamilton County clerk stamped the marriage license, federal law installed Diane as the default beneficiary of $612,000. Allison is now legally a stranger to that account. And here is where it gets surgical. The IRA portion, the rollover IRA, is technically not ERISA protected the same way the 401k is. But here is the problem. In community property states, state law gives the new spouse a community interest in any contributions made during the marriage, even on top of the federal framework. And in common law states, the spouse has elective share rights, somewhere between 30 and 50% of the augmented estate depending on the state, that can be exercised regardless of what the IRA beneficiary form says. So even on the IRA, where ERISA does not formally apply, the new spouse has a backdoor legal claim. Let me say it plain. Frank thinks his retirement money is going to Allison and his son David. Frank is wrong. The 401k portion goes to Diane in full. The IRA portion is exposed to Diane's elective share claim in probate. If Frank dies tonight and Diane invokes her statutory rights, and her attorney will tell her to, Allison and David collectively inherit somewhere in the upper double-digit percentage, less than they would have inherited 2 years ago, $612,000. Vaporized as inheritance, restored as marital property. The second account is the joint financial account. This is where it gets faster. Anyone who survives a remarriage and ends up reading my comments on this channel knows the joint titling problem because they have lived it. Here is the mechanic. The instant you add a new spouse's name to a checking account, a savings account, a brokerage account, a certificate of deposit, a money market, anywhere there is a JTWROS designation, meaning joint tenancy with right of survivorship, that account is no longer governed by your will. It is governed by the title on the account. And the title says, the survivor takes everything. The will is irrelevant. The trust is irrelevant. Your handwritten letter to Allison from 2017 explaining your intentions is irrelevant. If Frank moves Diane onto his money market account so they can pay for the trip to Italy together, and Frank dies in November, Diane takes the entire money market account. Even if the will says it goes to the kids, even if Frank thought he was just being convenient, even if Diane is honest and tries to give it back, the IRS will treat it as a gift from her to the kids, with all the gift tax consequences that come along with that. And the elder law lobby has been quietly fighting against any reform of this rule since 1987 because the brokerage industry makes a fortune on the titling churn. Watch the math here. Frank has a joint money market with $140,000. He added Diane's name in March. He dies in November. Allison receives 0. David receives 0. Diane receives $140,000. That is not Frank's intent. That is the operation of state and federal titling law working exactly the way it was written. The third account is the one that nobody talks about until the funeral. The transfer on death deed and the survivorship deed on the marital home. Frank's house is paid off. It is worth $410,000 in suburban Cincinnati. Frank and Margaret owned it jointly. When Margaret died, Frank received the house under the right of survivorship and a 100% step-up in basis under IRC, Section 1014. The basis is now $410,000. The mortgage is zero. The plan, in Frank's mind, was that when he died, the house would go to Allison and David equally, and they would either sell it or keep it for the grandkids. Here is the dirty trick the system plays. When Frank married Diane, his attorney suggested, and Frank agreed, that the deed be re-recorded to reflect Frank and Diane as joint tenants with right of survivorship. The reason given was elegant and sensible. If something happens to Frank, Diane needs to be able to stay in the home without going through probate, and a joint deed accomplishes that smoothly. Frank signed. Diane is now on the deed. That signature transferred half the equitable interest in the home to a person Frank has known for less than 3 years. If Frank dies first, and statistically, Frank, who is a 74-year-old American man married to a 58-year-old woman, will die first, Diane inherits the entire home. Allison and David inherit nothing. Worse, the half that Diane originally received via the joint titling did not receive a step-up in basis, because it was transferred during life, not at death. So if Diane sells the home later, half of that capital gain is taxable at her ordinary capital gains rate. The IRS makes money. Diane makes money. The kids make nothing. $612,000 in the IRA. $140,000 in the joint money market. $410,000 in the home. $1,162,000 in family wealth, redirected by 3 signatures Frank thought were routine paperwork. This is not an accident. This is not bad luck. This is the federal tax code and state titling law working exactly the way it was written, by people whose primary clients were not retired sales managers in suburban Cincinnati. Now you need to understand the villain. The villain is not Diane. Diane is a kind woman who makes chicken salad with grapes and walnuts. The villain is the architecture. ERISA was passed in 1974 to protect employees from their employers raiding pension funds. It was a good law. It was needed. But the Retirement Equity Act of 1984, passed in a different era with bipartisan support, added the automatic spousal beneficiary rule because at the time, in 1984, the typical American worker was a man. The typical American spouse was a woman who had not worked outside the home, and the policy concern was protecting widowed homemakers from being disinherited by husbands who had affairs in their 50s. That was the original policy purpose. Protect the long-suffering wife. The problem is that the law was never updated to distinguish between a 40-year marriage and a 6-month remarriage. A woman who supported her husband for 40 years and a woman who married him last March receive identical statutory rights to his retirement account. The Joint Committee on Taxation has been aware of this issue for decades. The Congressional Research Service has published memoranda on it. The American Academy of Elder Law Attorneys has been formally asking for reform since at least 2003. The legislatures have refused to touch it. There are committee hearings scheduled in at least 4 states this year on related elder protection issues, and not one of them addresses this specific spousal default. Why? Because the brokerage industry, the title insurance industry, and the matrimonial bar all profit from the current default settings, and none of them have an interest in changing the rules. The default settings of the American retirement system are calibrated for maximum probate fees, maximum title transfer revenue, and maximum administrative friction, not for the protection of the family lineage that built the wealth. The Deficit Reduction Act of 2005, which tightened Medicaid look-back enforcement to 5 years, was passed by an administration that ran on family values. The TCJA sunset, scheduled for the end of 2026, which will cut the estate tax exemption roughly in half, was written by a Congress that promised to protect the middle class. The Aubrey 1993 expansion of Medicaid estate recovery was passed by a Congress that promised to fight for working people. Every single one of these laws has been used, in the years since, to extract wealth from the exact demographic that the political speeches said they were protecting. The system is patient. The system is waiting. The system has built the mechanism. And the mechanism for the over 60 remarriage is the cleanest version of all of them, because it does not require an IRS audit. It does not require a Medicaid claim. It does not require a court order. It requires a wedding. The signing of one document at the county courthouse and the entire machinery of disinheritance executes itself silently in the background, with no notification to the deceased's children whatsoever. I want you to do something for me. Open the comment section right now. I do not care if you have ever commented on a YouTube video in your life. I want you to drop your field report. Tell me your age, your state, whether you are widowed or divorced or never married, whether you are considering a new relationship or already in one, and whether you have a retirement account over $250,000. Tell me whether you have biological children from the first marriage and whether they know what is on your beneficiary forms. I read every single one. I do not respond to all of them. There are thousands a week now, but I read them. The comment section on this channel is the field hospital. It is where I learn what is actually happening at the suburban kitchen tables of America, and it is what feeds the next video. The algorithm watches the comment count. Every comment is one more push toward another family who needs to see this before the wedding, not after. And listen, if your situation is complicated, say so. Say, I am 68, Ohio, widowed 2 years, IRA at 650, considering marrying my neighbor Carol. That is exactly the kind of comment that gets me to make the next specific video. The more concrete you are, the more I can help. Now, Frank, $612,000 in the IRA, $140 in the money market, $410 in the home. Diane in the kitchen humming Carole King. What should Frank have done before he signed the marriage license? What can you do if you are not yet Frank? Here are the 3 moves. Each one is legal. Each one is established. Each one is what an elder law attorney charges $1,200 to walk you through in a conference room. I am giving them to you for free in the next 8 minutes. The first move is the pre-marriage transfer and post-marriage waiver of the qualified retirement account. There are 2 paths. Path 1. Before the wedding, you sit down with an elder law attorney and you have a prenuptial agreement drafted that includes, and this is the language that matters, a specific waiver under ERISA, Section 205 of the Spousal Annuity and Beneficiary Rights with respect to your qualified plans. That waiver is then executed after the wedding in the form that the plan administrator requires, with the notarization and the specific statutory language. The reason for the 2-step is that ERISA spousal waivers, by federal regulation, cannot be signed by a non-spouse, so the prenup commits Diane to signing the waiver after the wedding, and then she actually signs the waiver after the wedding, and the plan administrator accepts it. If you do this correctly, the children remain the beneficiaries of the qualified plan. The new spouse signed away the statutory right. The signature is on file. The trustee honors the original designation. Path 2, which is what I would actually do if I were Frank and I had thought about this 6 months earlier. Roll the 401k into an IRA before the wedding, because IRAs are not subject to ERISA spousal rights in the same automatic way. Then structure the IRA beneficiary designation as a see-through trust, a properly drafted trust where the children are the beneficiaries, under the Secure Act and Secure 2.0 rules as they currently sit in 2026. The trust receives the distributions over the 10-year window under the Secure Act rules, and the children receive the after-tax amount. The math on Frank. If Frank does nothing, Diane inherits the $612,000 and the kids get nothing from that account. If Frank does the prenuptial plus postnuptial waiver path correctly, Allison and David each inherit roughly $300,000 pre-tax, which after the 10-year distribution and federal tax probably nets each of them somewhere in the range of $200,000 to $220,000. The gap between these 2 outcomes is more than $400,000. For Frank, who never made more than $72,000 a year in his life as a regional sales manager, that gap is a generation of his family's financial security. The second move is the joint account discipline. This is so simple it makes attorneys angry because it does not generate billable hours. You do not add the new spouse to any individually owned financial account. Ever. Not the checking, not the savings, not the money market, not the brokerage, not the certificate of deposit. If you want to share expenses with the new spouse, you open a new joint account for that purpose and you fund it monthly with a budgeted amount from your individual account, and you let the joint account sit at whatever balance the 2 of you agree on for household operations. $3,000, $5,000, $12,000. Whatever you spend in a normal month, times 2, with a buffer. The individual accounts stay individual. The beneficiary designations on those individual accounts stay your children, or your trust, or whoever you intended before the wedding. The titling does not change because nothing was added. Look at the dirty math. If Frank keeps the $140,000 money market in his name only, with Allison and David named as transfer on death beneficiaries, that account passes outside of probate, outside of Diane's elective share in most states, directly to the kids, in full, with no tax on the principal and a step-up in basis on any appreciated securities inside the account. Diane keeps her household joint account, which is funded at a reasonable level for monthly operations and continues to be funded out of Frank's pension during his life and reverts to her at his death, which is what an honest partnership in a remarriage actually looks like. There is the side-by-side, Frank A., who adds Diane to the money market because the bank teller suggested it as a convenience. Frank B., who opens a separate household account and leaves the original account in his name only. Same Frank, same Diane. Same $140,000. Frank A's kids inherit 0. Frank B's kids inherit $140,000. The difference is the bank teller's suggestion. The third move is the real estate move, and this is where you absolutely must have an attorney, because the choices vary by state and the consequences of getting it wrong are larger than the other two combined. You have 3 options for the marital home. Option 1. Keep the home in your individual name, do not add the new spouse to the deed, and grant the new spouse a life estate or a right of occupancy in your will or in a qualified personal residence trust. The new spouse gets the right to live in the house for the rest of her life if you die first, but the home itself passes to your children on her death, not to her heirs. This is the cleanest option. It is also the one that the new spouse may resist, because it signals that you are protecting the kid's interest over hers. Option 2. Sell the existing home before remarriage. Exercise the Section 121 capital gains exclusion if you qualify. Take the cash. Buy a new home in a different titling structure, designed specifically for the remarriage scenario, often as a tenancy in common with specific percentage interests and a buy-sell agreement embedded in a marital trust. This is more complex, but it is also the only way to fully control the asset. Option 3, which is what Frank should have done. Transfer the existing home into a qualified terminable interest property trust, or QTIP trust, before the wedding. The trust gives Diane the income from the home, meaning the right to live there for the rest of her life, but the principal passes to the children at her death. The IRS recognizes the QTIP under IRC Section 2056(b)(7). The marital deduction applies. There is no current gift tax, and the kid's inheritance is locked in legally. I am not telling you that Diane is dishonest. I am telling you that Diane's son in Phoenix, who you have never met, who has his own financial pressures, who watches his mother's account balances on the family iPad every Christmas, has a vote when his mother dies after you. And the vote he casts is the one that determines whether your grandchildren see a dime. The strategy is simple. The prenup waiver, the account discipline, the QTIP trust, 3 moves. Each one is established law. Each one has been used by the wealthy for half a century while being kept quiet from the middle-class retiree. Each one closes one of the 3 doors that opened when the marriage license was signed. And now we need to talk about your state, because the rules do not apply uniformly, and the variation matters more than most attorneys will admit. In Florida, which is the destination state for roughly 1 in 4 American retirees, the rules are uniquely brutal in one specific way. Florida has the elective share rule that gives the surviving spouse 30% of the augmented estate, which includes assets that would otherwise pass outside of probate, meaning the elective share can claw back into joint accounts, beneficiary designations, and revocable trusts. Florida also has the strongest homestead protection in the country, which sounds good but cuts both ways. The homestead cannot be devised away from a surviving spouse if there is a minor child. And even without minor children, the surviving spouse takes a life estate or a 1/2 interest by statute. Florida is the state where, if you remarry and do not handle the home with a QTIP or a specific homestead waiver in the prenup, the new spouse gets either a life estate or a 50% fee. Simple interest in your paid-off Tampa house, regardless of what your will says. Specific dollar terms. If your Florida house is worth $400,000, your kid's inheritance from the home is half of that at most, and only after the new spouse dies, meaning if she lives another 22 years, your kids inherit a house that has been depreciated, retitled, and possibly mortgaged in the meantime. In Ohio, where Frank lives, the elective share is 1/3 of the augmented estate if there are biological children from a prior marriage, and 1/2 if there are not. Ohio also has a transfer on death deed statute that is uniquely powerful. Under Ohio Revised Code Chapter 5302, you can record a transfer on death designation on a deed that bypasses probate entirely. But the key is timing. The TOD deed must be recorded before the marriage to fully insulate the property from the spousal elective share. If Frank had walked into the Hamilton County Recorder's office in February, before the wedding in May, and recorded a TOD deed naming Allison and David as the transfer on death beneficiaries of the marital home, that recording would have largely protected the asset. He did not. Now the elective share applies. Now the kids are exposed to a 1/3 claim on the equity, at minimum. In California, which is a community property state, the rules are different again. Anything Frank earned or accumulated during the marriage is community property, and Diane has a presumptive 1/2 interest. But anything Frank brought into the marriage, the existing IRA, the existing home, the existing money market, is separate property, as long as Frank is careful never to commingle. The instant Frank deposits a paycheck into the joint account, or refinances the home and adds Diane to the deed, or contributes to the IRA during the marriage, the commingling argument starts and the separate property protection erodes. California is the state where the discipline matters most, and where an experienced family law attorney will tell you that even one careless act of commingling can convert hundreds of thousands of dollars from separate to community in a single audit. 3 states, 3 different traps, 3 specific dollar amounts at stake. Same Frank, same Diane, different outcomes by zip code. If you are in another state, Pennsylvania, Texas, North Carolina, Arizona, the principles are the same, but the specific dollar thresholds vary. Pennsylvania has a 1/3 elective share. Texas is a community property state with a homestead protection that rivals Florida's. North Carolina has a year and a day rule on certain spousal rights that nobody talks about. Arizona is community property with a separate property tracing rule that is more forgiving than California's. There is no version of this where you can use a generic national template. You need a state-specific elder law attorney. Period. Now. The wedding is in 6 weeks, or 6 months, or 6 days, or it already happened. What do you do tonight? If the wedding has not happened yet, you call an elder law attorney in your state. Not a general practice attorney, not your cousin who does real estate closings, not your friend from the Rotary Club who has a JD on the wall. An elder law attorney who specifically handles remarriage planning for clients over 60. You ask for a consultation specifically on prenuptial planning, the post-marriage ERISA waiver, retitling of separate property assets, and the QTIP trust or equivalent. Expect to pay somewhere between $1,500 and $4,000 for the full package. That is 1 to 3% of what is at stake for a typical viewer of this channel. If the wedding has already happened, and many of you watching are sitting on the couch right now realizing the wedding was 3 years ago, you still have options, but the menu shrinks. The post-marriage waiver can still be executed if your new spouse is willing to sign. The QTIP trust can still be funded with assets you can keep clearly separate. The joint accounts can be unwound, though that conversation with the new spouse is a difficult one. The home retitling is harder once both names are on the deed, but it is not impossible. It can be done by mutual deed transfer back into a trust structure, often with a recital that protects against the appearance of fraudulent conveyance. The window is narrower than you think. Every year that passes after the wedding, the commingling deepens. The appreciated assets become harder to trace back to separate property status, and the new spouse's family begins to mentally inventory the assets they expect to inherit. The clock is ticking right now. I want you to do one more thing for me before we close this out. Pull out your phone. I want you to think of one person, not a list of people. One. The widow down the street who started dating a man named Ralph last spring. The retired teacher who married her high school sweetheart at 68 after 50 years apart. The cousin in Tampa who joked at Thanksgiving about meeting someone on a dating site for seniors. The brother in Phoenix who keeps saying he will get the paperwork done next year. One person, pull out your phone, hit the share icon on this video. Send it, one text message. No commentary required, just the link. They will watch it, or they will not, and either way, you did your part. One conversation now saves them somewhere in the range of $70,000 to $400,000 later. That is not an exaggeration. That is the math we just walked through together. Send the video, save the family. That is the entire ask. And then, for yourself, save this video. Bookmark it, add it to your private library. Put it in a playlist on your YouTube account titled something boring like Cincinnati Reds or cooking, so your new spouse does not click on it and ask uncomfortable questions over dinner. This is your survival manual. The next time you sit down with the attorney or the brokerage, you pull up this video on your phone and you go through it with him, and you ask him about the post-marriage ERISA waiver and the QTIP trust under Section 2056(b)(7 and the state-specific elective share, and you watch his face very carefully. If he is the right attorney, his face will light up because you are speaking his language. If he is the wrong attorney, his face will go blank and he will try to redirect you to a generic estate planning template. Walk out. Listen to me one more time. There is no version of this where waiting helps you. The marriage license has already been signed, or it is about to be signed, and either way, the meter is running on the asset transfers that are happening silently in the background, while you are humming along to Carole King in the kitchen. Frank is still in the garage with the fishing rod he has not used since 2019. Diane is in the kitchen. The Buick is on the left. The Chevy pickup is on the right. The workbench his father-in-law helped him build in 1987 is between them. And somewhere in a server farm in Northern Virginia, the brokerage's automated system has already updated his account records to reflect the marriage, and the default beneficiary on that $612,000 account is no longer Allison. It is Diane. Frank does not know this yet. Frank thinks the paperwork from 2009 still controls. Frank thinks Margaret's wishes are being honored. Frank thinks the system works the way the friendly commercials with the silver-haired couple kayaking through a sunlit lake said it works. You know now. You know because you watched this video instead of clicking on something else for the next 30 minutes. You know because you read the comments on this channel where other Franks have written in to say they figured it out in time and other widows have written in to say they figured it out too late. The choice is yours. The window is narrowing. The IRS is patient. The IRS is waiting. The brokerage is waiting. The matrimonial bar is waiting. The new spouse's family in Phoenix is waiting. Every party at this table has been waiting for this exact moment, except you. Hit the like button if you have not yet. Hit subscribe if this is your first video on this channel. Hit the bell for all notifications because the next video on the TCJA sunset coming at the end of this year is going to determine whether your estate exemption gets cut in half on January 1st. Drop your situation in the comments, your age, your state, your IRA balance, whether the wedding has happened or is on the calendar, and whether you have biological children from a prior marriage. I will read it tonight. I read them all. Save this video. Bookmark it. Watch it again next Tuesday, slower this time, with a notepad, and write down the 3 account types, the 3 moves, and the 3 state-specific rules for your state. Then call the attorney on Wednesday morning, not Wednesday afternoon, not Thursday. Wednesday morning before the second coffee. Stay sharp, stay liquid, stay protective. The remarriage trap was built for the retiree who does not know it exists. You know now. Stay angry and go act like.